When people hear that governments print money, they often assume something has gone wrong. The phrase itself sounds alarming. It suggests recklessness. It suggests shortcuts. It suggests artificial wealth creation. But in reality, expanding the money supply is not an accident. It is a structural feature of how modern economies are designed to function. To understand why governments print money, we first need to understand what money actually is. Money is not wealth by itself. It is a coordination tool. It allows individuals, businesses, and institutions to exchange goods and services efficiently. It acts as a unit of account. It allows value to be measured in consistent terms. It also acts as a store of value across time. But money only works properly within a system, and that system evolves as economies grow. In a small, static economy, the money supply can remain relatively stable. But modern economies are not static, they expand. Populations grow, businesses innovate, productivity increases, more goods and services are produced each year. When economic output increases, the amount of money circulating must also expand. If it does not, prices would fall continuously. This condition is known as deflation. Deflation sounds positive at first. Lower prices appear beneficial to consumers. But persistent deflation creates serious problems. If prices are expected to fall tomorrow, people delay spending today. When consumers delay spending, businesses earn less revenue. When revenue falls, companies cut investment, hiring slows, wages stagnate, the economy begins to contract. Deflation can become self-reinforcing. That is one reason modern monetary systems are designed to allow money supply growth. Another important factor is credit. Modern economies are credit-based systems. Most money is not printed physically, it is created through lending. When banks issue loans, new deposits are created. Those deposits function as money. This means that credit expansion increases the effective money supply. As investment increases and economic activity expands, credit grows alongside it. Without some expansion of money supply, credit-based systems would face constant liquidity shortages. This brings us to the role of central banks. Central banks do not directly manage day-to-day spending in the economy. Instead, they influence financial conditions. They adjust interest rates, they manage liquidity, they act as lenders of last resort. In stable periods, money supply tends to expand gradually. But during economic crises, the process accelerates. Consider what happens during a financial panic. Banks become cautious. Lending slows dramatically. Businesses struggle to access capital. Consumers reduce spending. Confidence declines. This creates a contraction in economic activity. If left unchecked, this contraction can spiral into recession or depression. In these moments, central banks intervene. They lower interest rates to encourage borrowing. They purchase financial assets to inject liquidity. They expand the monetary base. This is often described as printing money. The objective is not to create prosperity instantly. The objective is to prevent a collapse in financial intermediation. In other words, to keep the system functioning. There is also a fiscal dimension. Governments spend money on infrastructure, healthcare, education, and defense. When tax revenues fall during downturns, governments face budget shortfalls. To finance spending, they issue bonds. In certain situations, central banks may purchase these bonds. This increases the money supply. Again, the goal is stabilization, not artificial enrichment. However, money creation is not without risk. If money supply grows significantly faster than economic output, inflation emerges. Inflation reduces purchasing power. Savings lose real value. Cost of living rises. This is why central banks attempt to balance expansion with restraint. Too little money growth can lead to stagnation. Too much can lead to inflation. The system requires calibration. Historically, different monetary systems have approached this balance differently. Under a gold standard, money supply was tied to physical gold reserves. This limited flexibility. It also constrained economic expansion. Modern fiat systems removed that constraint. Fiat money has value because it is legally recognized and widely accepted. Its supply is managed through policy rather than physical scarcity. This flexibility allows governments to respond to crises, but it also requires discipline. Another structural reason governments print money relates to population growth. As populations increase, more transactions occur, more businesses operate, more wages are paid, the volume of exchange expands. Without an expanding money supply, transactional friction would increase. Liquidity shortages would become common. This is particularly important in globalized economies. International trade requires deep financial markets, stable credit systems, and responsive monetary frameworks. Money printing, in this context, becomes part of maintaining system functionality. It is not a shortcut, it is a mechanism. But mechanisms can be misused. When governments expand money supply to cover persistent structural deficits, inflation can accelerate. When monetary policy becomes politicized, confidence can decline. Confidence is central to fiat systems. Money holds value because people trust it will continue to be accepted tomorrow. If trust erodes, currency instability follows. This is why transparency and institutional independence matter. Central banks operate with mandates. Often these mandates focus on price stability and employment. Their credibility influences expectations. Expectations influence economic behavior, and economic behavior shapes outcomes. In simple terms, governments print money because modern economies require monetary flexibility. Fixed money systems struggle to accommodate growth, credit, and crisis response. Expanding money supply supports liquidity, supports lending, supports economic coordination. But it must be managed carefully. Money creation is neither inherently reckless nor inherently beneficial. It is a structural feature of a complex system. The real question is not whether governments print money. It is whether the institutions managing that expansion maintain balance between growth and stability. In simple terms, governments print money because the system requires flexibility. A fixed money supply would struggle to support a growing, credit-based economy. If you found this explanation useful, consider subscribing. This channel explores how economic, business, and investment systems work, and why they behave the way they do.